Hello everyone, it's Daniel Martin. Today I'm going to review a blog regarding the daily bias. The missing piece of the most traders analysis is actually for those ones that struggle on inconsistency, how to identify daily bias using the ICT concept. For those ones, what is not ICT concept is actually a new terminology, well, relative new, that has been used now to define what is actually bank levels trading. So what I'm going to do, I'm going to use my friends and colleagues to discuss this topic. We're going to have with us Peter and Maria and myself that will be interfering if it's needed to add more into this particular blog, which is being created by my fellow colleague Scott. Scott actually made this article. He's a very good ICT, and now I'm going to review to see if there is something to be added or is a fantastic clear for all of you to enjoy. So let's go for that. Remember one more thing, this is an audio blog. There is not any images or anything that you will missing, so it's for you to, when you're traveling from A to B, you will be able to listen to this article and enjoy a new knowledge and concepts for yourself as a trader. So let's go into the video now.
Something I think a lot of you listening will recognize. That feeling, right? You're staring at your chart, you feel like you're just constantly swimming upstream. You've done your homework on the higher time frames, you see the big trend, but then you zoom into the daily action and it's just noise.
Yeah, pure chaos sometimes.
Exactly. And those drawdowns start stacking up and get whipsawed back and forth on the lower time frames. It's frustrating.
It really is.
What if, and this is the key question today, what if there's this crucial piece you're overlooking, something that could bring real clarity to that daily battle?
You've absolutely hit the nail on the head there. That feeling. So common. And, many traders get hyper-focused on just trying to guess. Will the daily candle close green or red?
Right, the end result.
The end result. But the market, it almost never just goes straight from A to B, does it? This idea of daily bias, that's the missing piece. It's not just the destination, it's about understanding the market's intended path for that day.
The journey, not just the arrival.
Exactly. Anticipating those ebbs and flows within the day. Where's the manipulation likely to happen? Where's the smart money actually aiming? Because that's where the real intraday chances are, and frankly, where your sanity lies too.
Okay, I like that.
Okay, before we continue, this is actually very important for all of you to understand. I will on the blog that I will actually leave the link below to actually for you for see samples. I do understand that many of you maybe don't actually pay attention to this particular topic, but thinking about that, the candles, as we know, as a basic candle, you have an open and close. Let's think about a green candle. You have an open and close. You see a green candle, and then you see the wicks on the highs and the lows. Normally you see 2 wicks. It's very rare that you don't see 2 wicks at the top and at the bottom. Yeah, so that's the lowest and the highest. But there is more. What is above that wick and what is below that wick? There is orders, there is executions, there is somebody waiting to take the money from you, or you take the money from them. So be aware of that. So let's continue with this article discussion with Peter and Maria, and let's see how far we can get.
Let's really unpack this then. Today we're diving deep into daily bias, specifically using these powerful ICT concepts, inner circle trader concepts.
That's right.
And our mission really is to show you how understanding this can help you line up your trades with what the market is expected to do on any given day. How to cut through all that confusing lower time frame noise.
Think of it as getting a peek at the day's likely script.
Yeah, a shortcut maybe. A shortcut to thinking more like the pros, moving from just reacting to price wiggles to actually anticipating the day's story.
That's the goal.
All right, so let's start simple, but maybe bust a myth right away. What exactly is daily bias? Is it just calling heads or tails on whether the day ends up or down? Because I hear that a lot.
Oh, absolutely. That's probably the biggest misconception out there, and honestly, it trips up so many traders.
Right.
Daily bias is not about just predicting the close, bullish or bearish. It's too simplistic. It's really about anticipating the directional intent for the day.
The intent, okay.
Yeah, and the key turning points within that single trading day. Think of it like the market's likely roadmap for the next 24 hours. We're trying to figure out where is price likely going to reach for liquidity.
Okay, liquidity, meaning stop losses, pending orders.
Exactly. Where are those pools of stops sitting? Where are there imbalances like fair value gaps that need revisiting? And crucially, How might institutions manipulate price before they make their actual intended move? It's understanding that whole narrative, the journey.
That distinction feels huge already, just shifting from will it close green to how is it likely to get there. So why should someone listening right now really lean into this? What are the tangible benefits? What does having a solid daily bias give you?
Oh, the benefits are game-changing. Seriously. Imagine starting your day with a clear compass needle pointing the way.
Okay.
That's daily bias. It gives you this focused directional guide. Suddenly you're not chasing everything. You're cherry-picking the trades that have the wind at their back. High probability setups.
So filtering out the noise.
Completely. It becomes this framework, right? It protects you from jumping into those tempting counter-trend trades that, let's be honest, often just bleed your account slowly.
We've all been there.
We have. And with a clear bias, your execution tightens up. It becomes more precise because you're looking for entries that align with where the smart money is likely moving. You're flowing with them, not against them.
Makes sense.
And maybe most importantly, it massively improves your risk management. You can set stop losses and take profits that actually make sense based on the anticipated daily structure, not just random percentages.
So have you noticed that the first part is very clear? We're just actually looking for you to work in a story. You need to understand what actually is going to happen. So we try to play like a Sherlock Holmes locations where the market will react the more. What is the probability to react in one area or another? What they actually tend to be doing from one day to another? You see samples on the blog to actually to give you that clarity to understand the story behind the movements of the market of that day if you're going to be a day trader. So this is very important that you have your mind coming in as a day trader and you start looking to the market to see a story. This is where normally people will take the money. This is normally, it's not always 100%, be aware of that, but we're talking about high probability that they will be able to take liquidities. They were looking into value gaps. They were looking for order blocks. All these areas, actually, they are very important for you to create a map of what is going to be happening before the end of the day. What happened before the Asian market? What happened on the Euro market? What happened on the close of the New York market? So all this is important to be aware of all these manipulations and where they take out in and out, they clear these gaps, they get this. This is the key, is to be aware that there is a story behind before you start trading. So especially as a day trader. So let's continue with the article. Well, this is a blog and see if it's actually, let's see how far we can get with these concepts.
Based on where liquidity is or where it might reach?
Precisely. Without this kind of framework, traders get stuck. They overtrade. They chase reversals that aren't really reversals. They get stopped out constantly by these liquidity hunts that are, if you know what to look for, often quite predictable. Daily bias gives you the necessary context.
Context is key. It sounds like daily bias is the strategic overlay that makes the tactics, the actual entries, work much better.
That's a great way to put it.
So we get the why. It's critical. Now, the big question, the how. The source material we're looking at really emphasizes using ICT principles. Can we break those down? How do these specific principles help us figure out the daily bias?
Certainly. ICT principles, at their core, are about decoding how institutional money operates. They're designed to help us spot the footprints of this smart money.
Footprints, I like that.
Yeah, I like tracking them. We look at how price actively seeks liquidity, how it moves to rebalance inefficiencies in the market, and how it respects institutional order flow. We can boil this down into a pretty structured 5-step approach to build a reliable daily bias each day.
Okay, 5 steps. Let's dig in. What's step 1?
Step 1 is analyze the daily and the 4-hour order flow. Think of order flow as the market's underlying current. It's momentum.
The main direction.
Sort of, yeah. You need to ask yourself, are your recent major price swings and the key structures like order blocks and fair value gaps, are they supporting price moving higher? That suggests a bullish bias.
Okay.
Or are they pushing price lower, indicating a bearish bias? And sometimes price is just consolidating, right? Coiling up in a range.
Yeah, sideways chop.
Exactly. That signals more of a neutral bias. And when it's neutral, you should actually expect liquidity grabs. Price might spike up to grab stops, then spike down to grab stops before it finally chooses a real direction. It's about reading that underlying energy.
So it's not just guessing, it's reading these specific clues, these footprints, like you said, to understand what the bigger players are likely doing. It's structured interpretation.
Precisely. It's evidence-based, and that flows perfectly into step 2. Identify the current dealing range and liquidity pools. This is crucial. The market is always hunting liquidity. Always.
Like fuel for its moves.
Exactly like fuel. Before price makes a significant, sustained move, it very often makes a deceptive run first. It sweeps above a previous high or below a previous low. Why? To trigger stop losses and gather orders. That's the fuel.
Got it.
So you need to identify your current dealing range. Think of it as the current playing field for price. Often this is from a recent significant swing high down to a swing low, or vice versa. The key insight here is once price runs the liquidity on one side of that range,
Meaning it sweeps the stops.
yes, it sweeps the stops, grabs the orders. You can then often anticipate it targeting the liquidity resting on the other side of that range.
So be aware of that. This is important that you actually understand this. Take it into account that take one liquidity, the highs or the lows of the day. It doesn't guarantee that it will not come back again before hit the target. Be aware of that. So this is not 100% clear that there will be, they take the lows of the highs of the day or the liquidity zones to be able to fuel that energy that they need to moving forward before it's go back again and retest it. So be aware of that. This is not 100% in many of the cases. Normally, examples of indices will be able to be easier because normally tend to actually to go in the long direction, and that liquidity will be taken and they will not be back because the strength of the force to go long is much more than the going short. So this is actually quite important annotations. But remember, this is not for all the cases. Sometimes they actually will retest it 3 times, 4 times. So it's very important that you're aware of one specific instrument. So do not get because a number of touch or being able to, or this is happening one particular pair will happen in others, or this particular instrument happen this will happen the same from others. Do not mix them. Always remember to be in the same ones and try to be on the same time frame. This will be able to give you key elements for you to understand how often it happens, and when that happens you will be able to take advantage of these liquidities and to be able to make your profits when they hit the other side of the target. Yeah, so let's continue with this article.
Okay, like a pendulum.
Kind of, yeah.
Yeah.
And pay special attention to the highs and lows of the last 3 trading days. These are very high probability zones for liquidity. And also look for equal highs or equal lows on your chart.
Where price stopped at the same level multiple times.
Exactly. Those look like safe barriers, but to institutions, they're like giant magnets for liquidity. Prime spots for a stop-loss hunt just before the real move begins.
It really paints a picture.
Have to stop again here to make an annotation. This particular idea of the 3 days is actually something that is not true neither. It depends of the market that you're working on. It can be 3 days, can be 5 days, can be 1 week, 2 weeks. It depends of the volatility of the market. Normally, as you know, there is higher volatility happen on Wednesdays. In the majority of the cases, it's a bit choppy on Monday. They know where to go to the market. Friday is a bit actually out of the market because already the market is going to be end. But this is happen always with all the instruments, and the answer is no. So always remember that actually those numbers, 3 days, 4 days, 10 days, it depends. Sometimes it's even longer. So be aware of that. Yeah. So let's continue with this block.
Sure of the market setting traps, doesn't it? Triggering stops one way, then going the other. That's powerful.
It is. Which logically brings us to step 3. Recognize institutional order blocks and fair value gaps, FVGs. These are perhaps the clearest smart money footprints you'll find. Areas where you can anticipate price reacting significantly.
Okay, define those for us. Order blocks first.
Sure. A bullish order block is simply the last down close candle before a strong, sharp move higher. It represents a point where institutions likely absorbed all the selling and initiated large buy orders.
So the or of a strong up move.
Essentially, yes. And conversely, a bearish order block is the last up close candle before a sharp move down. That marks likely heavy institutional selling or distribution.
Got it. And fair value gaps, FVGs.
Fair value gaps, or FVGs, are areas on the chart where price moved very quickly, very aggressively, leaving an imbalance.
Like a gap.
Not necessarily a traditional gap, but an area where, within a 3 candle sequence, the wicks don't overlap. It shows one side of the market was overwhelming the other. Think of it like a vacuum or an inefficiency. Price often gets drawn back into these FVGs to rebalance or fill the gap before continuing its original direction. They act like magnets.
Wow. Okay. That's getting super specific, precise reference points. Now, I know time of day is a huge factor for intraday traders. How does that fit into shaping our daily bias?
Great question. That's our fourth step, and it introduces a really fascinating ICT concept called the power of three. You need to observe the Asian session range for manipulation.
Power of three. Accumulation, manipulation, distribution.
You got it. The idea is that price often moves in these three distinct phases within a 24-hour cycle. The Asian session, typically quieter, often serves as the accumulation phase. Institutions might be subtly building their positions there.
Okay, makes sense. Quiet accumulation.
Then often during the London session comes the manipulation. This is frequently a liquidity grab, a false move above the Asian high or below the Asian low, designed to trap traders on the wrong side.
Ah, the trap.
The trap. And then, usually kicking off in the New York session, comes the distribution, the real, intended move for the day. So how does this help with bias?
Yeah, how do we use it?
Well, if you see price decisively sweep below the Asian session low during London, and then reverse aggressively and start pushing higher, that's a strong clue for a bullish daily bias.
Because the manipulation was to the downside.
Exactly. And conversely, if price sweeps above the Asian high and then turns and drops sharply, that points towards a bearish daily bias. It's a powerful early warning system for the day's likely narrative.
That's a game changer. The Asian session isn't just dead time then. It's setting the stage. That alone could really sharpen focus.
It absolutely can. And finally,
Before we continue with this this block, this is actually an example of what is called manipulations. Pretty much is actually the clear the highs and the lows and the take direction. So be aware of that. As I said before, with all the other examples, this must be actually to analyze for each instrument at the same time.
Step 5 in building our bias. Consider the macro environment and economic calendar. Now, ICT is heavily technical, right?
Yeah, mostly chart-based.
Mostly. But ignoring the bigger picture. Well, it's like trying to navigate a ship without glancing at the weather forecast. High-impact news events, think NFP, CPI data, FOMC announcements.
The big red folders on the calendar?
Those. They aren't just random noise. Institutions often use these events. They act as catalysts for huge liquidity sweeps, shaking out weaker participants before initiating their larger, planned moves.
So the news justifies the manipulation, in a way.
It can provide the volatility needed for it, yes. Also, just having a general awareness of longer-term institutional positioning, maybe glancing at commitment of traders, supports occasionally, or understanding major central bank policy shifts gives you valuable top-down context. Where is the really big money leaning?
Right, the prevailing winds.
Exactly. It just shows that even with highly precise technical methods, layering in that broader market awareness really strengthens your conviction in the bias. It's about combining that micro-precision with macro context.
That's a really comprehensive framework. 5 solid steps to figure out the likely daily direction. So the crucial next step, what does this mean for you, the listener, when you're actually sitting down to trade? How do we translate this daily bias strategy into pulling the trigger? From knowing to doing.
Right, the execution part. This is where the rubber meets the road. First, once you've established your daily bias using those steps, you need to identify key points of interest, your POIs.
Okay, POIs.
Before you even think about clicking buy or sell, mark these significant zones on your chart. Where do you expect price to react? This includes those liquidity levels we talked about, previous daily highs, lows, those equal highs, lows, obvious swing point.
The magnets.
The magnets, exactly. And critically, mark out the specific order blocks and fair value gaps that align with your bias. These are your high probability zones where price might pull back to before continuing its move. And don't forget session highs and lows. The London high or low, for instance, often gives strong clues.
Okay, so the daily bias...
So before we continue, so yeah, now you realize, guys, that this a fantastic blog or article is to explain to you how to actually to work out a story, to understand, to have the most important thing is that it's telling you to be patient, to create a process, to working into the nuggets that give you the strategy. They give you some nuggets here and then for you to wait until that has been hit, until this has happened. So the key is that to be able to learn to have patience, to have a story behind, to work in the process step by step. So be aware of that. It's important that you working not only this concept, ICT concept, which is actually bank levels, it's a name, it's been converted to make it clear for all of you. Just be aware this is actually the movement, the story behind is teaching you to have patience, to looking for those nuggets, to those stories, to understand how markets move, what is actually is fear, is panic, is some some banks is there here. What is a trap? What is a trap to actually to take my money from me? So this is the key, is to you working a step-by-step process before you make a decision. This is actually teaching you to be patient and to be able to take advantage of that patience on the daily bias. So let's continue with this block.
Tells us which direction to favor, and the POIs tell us where to look for potential setups within that direction. But like you said, we're not actually trading off that daily chart itself, right? The stops would be huge.
Absolutely not. That leads directly to the second key execution step. Drop to a lower time frame for entry confirmation. Your daily bias gives the strategic direction, the context. But the tactical execution, that happens on lower time frames. Maybe the 1 hour, the 15-minute, even the 5-minute for scalpers.
What are we looking for there?
You're looking for confirmation signals that align with your higher time frame daily bias. A classic one is a market structure shift on that lower time frame. So if your bias is bullish, you want to see price break above a recent lower time frame swing high.
A sign the tide is turning locally.
Precisely. If your bias is bearish, you look for a break below a recent swing low. You can also look for optimal trade entries, OTE. These often use Fibonacci retracements, looking for pullbacks into that sweet spot, typically the 62% to 79% retracement level that lines up with an FEG or order block.
The discount zone.
So I want to actually to make it clear. This is actually the beginners of these samples. You can see on the blog, on the article, you will see some samples of how you can actually take into, how to actually look into your enter, how to enter exactly. Because one thing is to understand the story behind, the mapping behind what is going on around the whole story around, and to know which direction I'm going to take, when I'm going to take it to. But now when actually you go into the entry, there is many hundreds of combinations, and this is one of the samples it's giving you, but there is much more options that you can use. Any other options, there is many options there to be able to take your trades into the right entry. Because as soon as you go to very small time frame, obviously you need to take into account many things, like the spread can kill you trade easily, so be aware of this as well. So it's good to know the direction, it's good to have a plan, it's good to have actually the ideas clear before you take the trade. Now when you take the trade, it's another story, be aware of that.
Discount or premium zone, yeah. But the absolute key here is patience. Always wait for clear confirmation before jumping in. That could be a strong rejection candle, an engulfing pattern, a decisive move back into an FEG. Something that tells you, okay, the move I anticipated is likely starting now.
Wait for the evidence. Don't front run it.
Never front run it. And that flows into the third execution step. Set realistic stop loss and profit targets. This isn't separate from your analysis, it's integrated. Your risk management has to make sense with your bias and POIs.
So not just random pips away.
Definitely not. For example, if you enter long off a bullish order block after a liquidity sweep, your stop loss might go logically just below that order block, or maybe below the low of the sweep wick.
Okay, protecting the entry reason.
Exactly, and your take profit. Aim for the next significant liquidity pool or major imbalance zone that aligns with your overall daily bias, the previous day's high maybe, or a prominent FEG higher up. This ensures your potential reward justifies the risk, and your targets are based on market structure, not hope.
That's such a clear, structured way to approach it. Let's try to crystallize this. Walk us through a quick, concrete example. Let's say you've done the analysis. Daily chart looks bullish, strong order flow pushing up. You see a nice FEG and an order block lining up neatly near yesterday's low. And there's obvious liquidity, maybe equal highs sitting above yesterday's high. What's the play-by-play?
Okay, perfect scenario. So bias is bullish. POIs are the FE order block near the previous low potential entry area, and the liquidity above the previous high potential target. Now we drop to a lower time frame, say the 15-minute.
Right.
We're watching price action. Maybe during a London session, we see price dip down and sweep below that previous day's low, maybe just kissing that FEG or order block. Stops get triggered below the low.
The manipulation.
The manipulation. But then crucially, instead of continuing down, price aggressively reverses. It pushes back up strongly and maybe breaks above a recent 15-minute swing high. That's our market structure shift.
Confirmation.
Confirmation that aligns with our bullish bias. So a high probability long entry could be triggered as price retraces slightly back into that FEG or the order block where the reversal started.
Got it. Entry placed. Stop loss.
Stop loss goes just below the low of that manipulation sweep or below the order block itself, giving it some breathing room.
Okay. And the target.
So this is simple that has been given you. Just take your time. Take your time to picture will look like. It is important that you understand the concepts. Where will we actually be take the direction? Where is my plan? How I will be execute the trade. Take your time, even revisit multiple times the same part of the video of this review. But you must to understand that you don't need to look the charts. You need to actually to have it in your head. You need to see what has been telling you to understand. Okay, this is how I'm going to do it. I'm going to take this, I'm going to do that. So all that into your head is actually a very, very important, because that is actually giving you a honest confirmation that you do not have doubts on your strategy. Okay, so be aware of that. All right, guys, so let's continue.
Target.
The primary target would be that liquidity resting above the previous day's high. That's the logical draw on price based on our bias. By following this step by step, you're not guessing. You're anticipating the likely moves of smart money and positioning yourself to ride along. You're trading with the narrative.
Wow, what a difference that makes. This whole deep dive, it really hammers home that trying to trade without that daily context, without understanding the likely bias, it's like flying blind, isn't it?
It really is.
So many traders get stuck in that cycle, inconsistency, frustration, because they're just chasing signals without understanding the story the market is telling for that day. Nailing down this daily bias seems like it removes a huge layer of that uncertainty.
It does. It helps you align with those powerful institutional flows. It dramatically improves consistency.
So just to recap the absolute essentials for everyone listening, what are the key takeaways they should focus on?
Okay, 4 main things. 1, start high time frame. Identify those key liquidity pools and confirm the institutional order flow on your daily chart. Like, get the big picture first. 2, become a detective. Track how price manipulates liquidity, often subtly, before it makes its real move for the day. Look for this sweep.
Okay.
3, master the ICT tools. Use those order blocks, fair value gaps, and optimal trade entries to pinpoint your highest probability zones for action, zones that align with your bias.
The footprints.
And 4, execute with precision. Drop to lower time frames, but always wait for confirmation that aligns with your daily bias before you commit capital. Patience pays.
That's incredibly clear.
This structured, anticipatory way of thinking, this is how professionals tend to approach the market. It fundamentally shifts you. You move away from just reacting, or worse, guessing, towards confidently, precisely anticipating price movements.
A total perspective shift.
It really is. And that leaves a crucial question for you listening right now. Look at your current daily routine, your analysis. What part of it could be transformed by truly understanding this deeper context of daily market movement? How could mastering this missing piece, this daily bias, shift your perspective from just reacting to truly anticipating?
That is a fantastic question to ponder, and a great challenge to take forward into your own trading journey. Well, this has been incredibly insightful. Thank you for breaking that down.
Hey there.
Sorry,
Wanna share your
thank
thoughts on this?
you, Peter, Maria. Thank you very much for taking us through this daily bias from ICT concept. It was a fantastic to going through all these step by steps, and just been adding some notes as we're speaking through the process to make sure it was actually totally clear for the audience. So thank you very much, and I will see you on the next podcast. Thank you. Bye now.
Thank you so much for joining us and for your kind words.
Yeah, that's really fantastic feedback to hear.
We really appreciate you tuning in and taking those notes as we went along.
That's exactly what we hope for you to be able to apply this.
It's all about making these concepts practical and clear for everyone.
Absolutely. We definitely appreciate you being here.
And we hope those steps provide a solid framework for your trading.
Yeah, hopefully it clarifies that whole missing piece we talked about.
That's the goal, to help shift that perspective for you.
So glad you found it insightful and helpful for your journey.
My pleasure.
And thank you all for joining us on this deep dive.
Keep digging, keep learning, and refining your daily bias.
We'll catch you on the next one.
Thank you everyone for listening to this fantastic podcast. We will continue doing more of this analysis of articles, blogs, video content, or anything that you would like me to actually to discuss. So I will use my two colleagues. As you noticed, there is two AIs working with me. One of them is Maria, and the other one is Peter. They are professional traders with actually the actually active agents that they will help me to going through these daily activities for all of you to enjoy. So all this will be audio books, audio articles, audio blogs, review videos if you want me to, anything that you're actually looking for, we will do it together. And this will actually added more value for all of you, because as you notice, I'm going through the article, I'm going through the blogs, explain the exercise, and on top of that I try to make sure there is nothing missing. So I'm thinking about my thinking and helping you guys to make yourself as well and entertain as much possible, to make sure that you, the listener, understand the concept and you actually save time when you're just going to A to B. Like me, I don't like to I go, as all of them, do you know me, I just got difficulties to read books, and for me, and I've actually been audiobooks for a long time, for me this is actually a benefit for my own self. And I said, well, why not? I can use this at the same time to help others to know what am I talking about, to be totally transparent when actually going through an article, a blog, a video, and then you can actually see that on if you like it. So if you really like it, let me know and I will be able to do more of this. So guys, see you in the next one. Bye now.